Hello and welcome to the Assay. Today I am happy to be joined by Rick Squire, Portfolio Manager for Resources and Energy at Acorn Capital. So Rick, thanks so much for joining us here today.
Thanks for having me, Amy.
Always a pleasure to be able to catch up and hear your insights. So, this is going to be going into the ASX edition of the magazine. So maybe we could just start with you describing what you see as the current state of the ASX junior market. So, are there interesting key trends that have emerged over the past 12 to 18 months or so?
Yeah, so the way I'm seeing the market behaving in the resources sector is pretty much consistent with how you'd expect to see it. And what I mean by that is in the gold sector, for example, there was the big run in the gold price late last year or mid to late last year, and that's continued on, not as strong, but it's continued into 2025. And what you see typically in the small end of the resources sector is the first stocks to move are actually the producers. And when they become fully valued, it then cycles down into the developers. And only in the latter stages of a strong commodity or particularly a bull market do you actually see the explorers coming through. So a good example of that is you look at the big names in gold, like the Newmonts and the Northern Stars. They pretty much got to their peak price in about October last year, and since then, there hasn't been that much appreciation. It's been up and down based on good or bad news flow, but essentially the share price is tracked sideways. But what took over in that period from October to probably the last about a month or so ago were the next wave of developers, all those companies that were ramping up production. So good examples of that are companies like Mika, Pantoro Gold, where they're either getting into production or they're going through that ramp up stage of expanding that production, and that's where the real beneficiaries have been in the last month or so. Just starting to see the early signs of some of those explorers start to pick up. So again, it's that nice progression, that nice wave where the producers move first, then it's the developers, and then the explorers come through at that tail end. And so that's where the opportunity is. And I think you can look across the commodities and you understand where we are in the cycle for that commodity. That's where I think we're seeing how the stocks are performing.
Okay, so apart from gold, which commodities are most attractive to you right now from an investment perspective?
Yeah, gold is definitely the standout, but there are other commodities I like. What's really picked up just recently has been some of those strategic metals like lithium, rare earths, graphite, even some of the funky metals like antimony, and that's where taking this reliance away from China. It's not just everyone talks about geopolitical, but it's really a business risk as much as it's a sovereign risk. So that's why there's a real focus on that, and I think the deal that the US government did with MP Minerals on their rare earth project, that they actually come in and the government is actually taking a stake in the company, as well as putting a floor on the price that they can get for their product or part of their the product that they produce. That's a real game changer in terms of how we think about and how we value companies in that particular sector. So that was for rare earth elements. You can see similar opportunities in the graphite space. Lithium's a little bit different. It's a little bit there are some other options there. It's not so heavily reliant on China, even though it is strongly reliant. It's not like the rare earth sector or the graphite. So I think probably 2 months ago it wasn't really a sector that anyone had much interest in, but I think there's a real change in the game there. So that's a really important change. Apart from that, copper is also always something that we really like and look out for. But that's as much there are very few opportunities, so it's always been difficult.
Yeah, and I mean there was just that announcement about CATL closing operations for their lithium mine. And, how do you see that impacting lithium? It seems to have brought maybe a renewed interest or.
Yeah, definitely. There's been some news flow. There's always this news flow that if it comes out at a particular time, it gathers a lot of momentum. And that what we're seeing out of CATL, closing down some of the lepidolite mines. They were operating under these licenses to be a kaolin mine, like a clay mine. And the byproduct was the lithium, and the government's worked out that that's not actually the case. It's probably more a lithium mine operating on a kaolin license, and so they're trying to crack down on those things. It might take 3 months, 6 months, 12 months to wash through, but it's certainly a disruption. Which at this point in time, with the other news flow coming out of the US, it's perfectly timed and creating a great opportunity for those trying to sort of pick the bottom. But you just got to be careful at the bottom of particularly after a really strong bull market like lithium experienced, that the downside, the bear market that follows it can often be a lot deeper and for a lot longer than you expect.
Okay, interesting. And so going back to kind of the previous question, talking about commodities that you're attracted to. So you didn't mention nickel or iron ore as one of these. So why is that?
Yeah, just a struggle in terms of their reliance on the construction market in China in particular, in Asia generally. They're the big consumers of iron ore. And that's a little bit more subdued. Now, I know nickel goes into batteries and to other components, but it's only a very small percentage of the overall production. And so the real driver is still that steel production. And the outlook there, it's not that the big companies like BHP and Rio and FMG will stop making money. I just think that heyday of profitability that they've had is will be more subdued. And so particularly in the case of iron ore, you've got production that's returning to Brazil, which was after the tailings dam disasters probably 8 years ago now, that there was a lot of production that was shut down. Now that's all starting to return. At the same time, you've got some production that's starting up in West Africa from Guinea. And I think that combination of returning production from Brazil, new production from Guinea, all that money that's been spent in Western Australia to increase the size and the efficiency of the Australian operations, just makes it really difficult for iron ore. And then the Indonesians, in terms of nickel production, the Indonesians are just producing so much nickel at such a cheap price. It's really hard for an ASX listed company to compete with them. So those two commodities are probably the two that I'm least enthusiastic about.
Yeah, I mean, and that's fair enough. So kind of just shifting over to looking at junior miners specifically. So what kind of signs do you look for in these corporates that would signal a genuine long-term potential, as opposed to short-term kind of smaller hype?
Yeah, that's a really good question. It sort of goes back to the comment I was making at the beginning of the interview, that it's really important for investors to understand that cycle that resources companies go through. That when you see an upswing, generally speaking, you don't get all boats rising at the same time. The first ones to respond will be the producers, and intuitively you think that through. It's like, well, if you're in gold and the gold price has been bearish for a while, or maybe lithium's a good example. Lithium's coming back now. Should you go and invest in those explorers? I would strongly argue that it's not the way to do it. What you're best off doing is actually going to the producers, and that's where the first stocks will run. And they're the first ones to take off. And when you see good value and they start to level out at a reasonable valuation, then you can move into the developers, and the last stocks to move into are the explorers. So what you're seeing in this recent run is a really good example of the price has gone up. You've seen stocks like Pilbara and Sayona. They're the producers. They've run. Now, a couple of the developers have also gone up in the last month or so. but very quickly those companies have gone and raised quite a bit of money, and so when they do the raise, it's at a discount. So if you don't get out before that raise, you can actually undo a lot of that good work. So ultimately, the stock, the developer, is moving sideways because it goes up. They do a raise, the price goes down. The investors get a little bit miffed that they've picked the right commodity, but their stock is going sideways when the commodity price is going up, and then they start to cycle out, and that's why it just sort of, it's volatile, but it broadly speaking, it just sort of tracks sideways. And in terms of the explorers, it's very difficult to see any opportunity for those explorers until that nickel price is really entrenched and running, and so it's really not a great space to be in the near term.
Yeah, absolutely. And so, I mean, you've talked quite a bit about tracking the commodity cycle. So what advice would you give to retail investors that are looking to gain exposure to junior mining plays on the ASX? So, looking at managing risk and this volatility that you were talking about.
Yeah, it's a really good question because you've got to think about two key factors. You think about commodity exposure, so getting exposure to different commodities, not being tilted in just one commodity, but also think about the stage of development in terms of, is it a producer, developer, or explorer? So in the gold sector, it's probably not a great place to be to sit in that gold producer right now. You'll probably want, if you really wanted to maximize your gain from that sector, you want to be moving down towards those developers and the explorers. And that's where the growth opportunity will come from. You'll get your dividends. I'm not saying it's a bad move being in Northern Star or Newmont, but that's where you'll just get steady growth. You get some dividend return. That's the conservative place to be. If you want real growth and real opportunity, it's at the small end. But having said that, that doesn't apply to lithium, because lithium's coming out of a deep bear market, that you actually want to be up at the producer end of that market and investing there. And so it's not as though you just want a couple of lithium explorers, a couple of gold explorers. That's actually not a very efficient way to build your portfolio. You've got to think about, where are we in the commodity cycle for the different commodities you're investing in. And based on that, that's how you actually invest your money. So you're better off being in lithium producers right now, but in the explorers and developers, and maybe a smaller number of producers. Now you weight that according to where your risk tolerance is, but that's a better way of thinking about it, in terms of mitigating some of that risk, but also maximizing some of the opportunities.
Okay, interesting. It's quite detailed, and I think understanding kind of the different commodities and how their cycles are tracking is definitely quite important. And so finally, looking ahead to 2026, what's your outlook for the Australian junior mining sector? Are we in a downturn? Is this a transitional phase? What do you see happening here?
Yeah, I think it's going to be continue along with how we're seeing it at the moment. Just that nice progression, and it's just at Acorn Capital, we've been investing in resources and energy for over 25 years, and so really understanding that cycle, understanding where we are in the cycles for the different commodities, and watching that. But we're always positive on the where the opportunity is, and so, but also you just got to be aware of the risks around some things, and so you just don't know what might come out of the US or where it might be that can really disrupt it. I don't think anyone saw the war in Ukraine breaking out yet. Yet that had an enormous impact on the commodity sector when that broke out. So there are always unforeseen risks, and that's why you've always got to be that element of caution, because there can be some really big unforeseen disruptions. But generally speaking, if you look at what you see today, it's actually positive. We're seeing great opportunities, and some companies are making some discoveries, and there's some great value to be had. So we're keen to continue capitalising on the opportunity.
Yes, excellent. And we're certainly hoping to, showcase Australian ASX listed juniors at various events. But yeah, I mean, Rick, so thank you for your insights today. It's great to hear kind of from the ground what's happening over there. And we should definitely catch up again in the next couple of months to see how things are progressing even further.
Thanks for having me, Amy. Good to chat.